All right, we'll do a quick run through of the notes, and this might help with the reading a little bit as you kind of go through and we make sense of some of the terms that you're going to have to understand here in Chapter 7. Chapter 7 really is introducing a lot of the terms that are going to be necessary to kind of understand the behaviors and the decisions of firms that we're going to look at in the next two chapters. When we look at perfect competition, our markets that operate in a perfectly competitive market structure, or a monopoly market structure, or an oligopoly market structure. We got to understand some of these basic business and economic concepts in order to kind of understand the decisions that firms make and why they do. So we'll go through these notes real quick. I'll break it in a couple of videos so we don't get too long here. But first, we're going to introduce the concepts of cost and profit and some of the definitions. Remember when we talked about the goal of the individual is to maximize self-interest, right? Individuals seek to maximize their utility, make decisions that are going to, make us feel and be better off. Producers, okay, we're looking at supply curve side now, their goal is to maximize profit. So we're going to look at different types of profit and how we calculate profit. All resources, when you use them, okay, have an opportunity cost. If you use some land, labor, capital for one endeavor, you cannot use that same land, labor, and capital for another. So all the costs that we're talking about involve an opportunity cost, but we're going to break them down into two different kinds. We got explicit and implicit. And explicit costs are going to probably make a little bit more sense. These are costs that show up on a business statement. They usually they do involve a cash payment, and they're on your accounting statement. So if you are going to buy a ton of steel to make an automobile, right? You have to pay for that steel. That would be an explicit cost that you would have to pay in order to produce that good, that car. And that steel would be paid for with cash. It would be on your account statement, and auditors would see that when they go through your books. So it's pretty easy to understand. If you're at a company where you mowed lawns, you need to purchase gasoline to put in your lawnmowers. That would be an explicit cost. The other side is what we call implicit costs, and these are a firm or a business owner's opportunity cost of using its own resources that it's provided by the owners of the firm. So this is the opportunity cost that you have of resources that you own that you're not paying cash for. So there is no corresponding cash payment. This is not an accounting statement. It doesn't show up in an accounting statement, but it's still a cost nonetheless. So let's say I have a garage that I could rent out. I could charge somebody $100 a month to store their stuff there, use it to generate some sort of revenue. If I was going to take that garage and use it for my own business, maybe store my lawnmowers, for my previous example, in this garage, it's helping me, right, run a business. However, okay, I own it. I'm not paying rent to myself, but there is an implicit cost because I could be renting that out, getting $100 of revenue or income from renting that out. So there is a cost. It's just not an actual cash payment. I'm not paying rent to somebody else. I'm essentially paying it to myself. So that's the idea of implicit costs. If I were to go and quit my teaching job and become a professional golfer, right? What I'm giving up to be a professional golfer is my salary of being a teacher, and that would be an implicit cost, right? My foregone salary that I gave up is a cost of me becoming a professional golfer. It is the opportunity cost of my time that I'm giving up. So implicit, no cash payment, but they are a cost and are important to understand. So we're going to look at a profit in a couple different ways. What you're probably most familiar with is this idea of accounting profit. If you take the total revenue, so that's all the money that comes in from sales of your goods and services, and you subtract all your explicit costs, so everything that you put a cash payment on. Simple example, lemonade stand. Some explicit costs. You might have to go to the dollar store, buy some styrofoam cups, buy some sugar, buy some lemonade seasoning and some lemons or whatever, ice, whatever it might be. Those would be things you'd have to pay cash for. Those would be explicit costs. You take the total dollar amount that you got of revenue coming in. So if you're selling it for $1 a cup and you sold 10 cups, 10 times 1, $1 for each, you'd have a total revenue of $10. And if your costs cost you $5 in cups and sugar and ice and everything else, those would be your explicit costs. So you take your total revenue of 10, you subtract your costs of 5, and that would give you an accounting profit. Okay, an accounting profit of $5. Pretty simple. Total revenue minus explicit costs. Economic profit is a little different. Remember that idea of implicit. Okay? Economic profit is total revenue minus all costs, implicit and explicit. This is the opportunity cost of all of your resources, even those that you own. In my previous example, or in my lemonade example, your time is not free. You could be doing something else than selling lemonade. You could be mowing a lawn. Right? So if you're sitting there and you're spending all afternoon sitting at your lemonade stand, watching TikTok videos while you're waiting for customers to show up, okay, you could be maybe mowing your neighbor's lawn for $15. So there is an implicit cost that you are giving up, and that's the highest valued alternative of your resources, right, that you're giving up. In this case, it would be the time. So economic profit is your total revenue minus all costs, both implicit and explicit. Accounting, economic. Now, normal profit, we're not going to get into it a whole lot, but to think about normal profit as this is all of the accounting profit that you earn, right? Okay, that covers their opportunity cost. So think about normal profit is all the profit until you cover all the way up to, and we get into what we call the economic profit. It's the difference between the accounting profit and economic profit. Again, not a lot of time, we're not going to spend a ton of time, we're going to move through that portion pretty quickly. But accounting and economic are the two big ones we need to focus on. A quick example, this is in your book. You can kind of see it and break it down. It kind of identifies the costs. So you get your total revenue from sales. So that's all the money you coming in from all the sale of your goods and services of $105,000. You got explicit costs. You got to pay your assistant a salary. That's cash, material, and equipment. This would be all of those, tangible things. Okay. So you take these costs, you subtract them from your total revenue, and that's $64,000. So you have an accounting profit of $64,000. Well, Wanda, in this example, could be doing something else. She had an old job, a $50,000 salary that she gave up. She gave up some interest on her savings. She gave up a garage rental. So these are all things that she owned and spent, all right? So here we have $52,200 that had she not run this tire business, I think is what it is in the book. I'd have to go back and look, but she would be, earning. So this kind of helps us understand, well, would I be better off running my own business or working my 9-to-5 job? So minus your explicit cost, that gives us an accounting profit, minus both explicit and implicit. This is what we call our economic profit. My economic profit shows here, it's positive that she is better off, right, running her own business, this wheeler-dealer business versus staying in her current job. Okay. We're going to quickly introduce, I'll do this relatively quick, short run and long run. These are concepts. If you think of the short run as where output is produced, the short run, we have at least one resource is fixed, meaning we cannot change some resource. Okay, it cannot be varied relatively quickly. So if we're looking at a McDonald's restaurant, you could increase your variable. You could buy more hamburger, you could buy more fries, you could bring more people, hire them on very, very quickly. You could do that in a day. But you cannot maybe change the size of the building or add another drive-through window in a very short period of time. So the actual building would be what we call a fixed resource. And in the short run, think of this as all the producing happens in the short run. at least one resource is fixed. The long run is kind of this planning phase, So if I owned a McDonald's, like, God, we should do a lot more business if I added a second drive-through, or we expanded the size of the seating area. These are things that can be done over a long period of time. And in the long run, we say this is the planning phase. Right? No production happens in the long run. No resources are fixed. Right? We could go and we could plan out, and we could build a new building, increase the size, increase the capacity. And then as soon as that was completed, we'd be back in the short run again. Right? So you have variable resources. These can be varied in the short run to increase or decrease production. I can bring on new workers quickly, right? Purchase more hamburger buns. Those are things that can change based on output, increase, decrease production. If we have a slow time, I don't need to order as much. I don't need to bring in as much help or labor. And so that's kind of the difference. Fixed, these are not varied in the short run. Okay. We'll get to output here in the next video. I'm going to stop there though.